Right now, buyers think they're in control because days on market are climbing, but if mortgage rates keep slipping under 6.5 while sellers stay stuck, the so-called buyer's market could flip back to a seller's market in a heartbeat. I'm Karl Kyler, your San Diego Realtor, and it's that time of the month where you and I take a deep dive into the latest market data to see what's really happening here in San Diego. Now, if you haven't liked and subscribed yet, consider doing so now, or you can wait until the end to see if there's enough value in this video for you. Either way, let's dig into the numbers and see where the market is heading. Let's kick things off with new listings because August told us a lot about how supply is really shifting. On the detached side of the market, we had 1,731 homes hit the market. That's down 18.5% compared to last August. So even though buyers might feel like they're seeing more for sale signs than last year, the actual flow of new detached inventory is shrinking, and that's a significant number right there. Now for attached homes, which means condos, townhomes, and apartments, these brought in 1,159 new listings, which is basically flat, just down 3.7% year over year. What's important to note here is that earlier this year on the attached side of the market, we had year over year growth in the 20% range, and now we're at a negative number. That's not ideal, especially if you're hoping prices were going to come down soon. So overall, August wasn't a month of growth. Now, when you zoom out to year-to-date numbers, the story sounds a little better. Detached listings are still up 8.5%, and attached listings are nearly 17%. But here's the kicker. Those year-to-date gains are shrinking. Back in the spring, detached growth was running in double digits. By August, it's cooled way down to a single digit. And if you remember, in 2023 and 2024, we are already at record low inventory levels. So if this downtrend continues, we'll start burning through what little cushion we've built. And that's the kind of setup where a lower mortgage rate environment will cause buyers to flood back into the market and supply could tighten in a heartbeat. Which, by the way, the labor report that we just got brought rates sub 6.5%. There are even buyers locking up sub 6% with government-backed loans. So there's a chance that this cushion of inventory that we've built up this year can disappear really quick. Here's what you want to take away from this metric. August wasn't the flood of new options buyers were hoping for. It's more like a drizzle. And as far as I'm concerned, the only time a drizzle is dangerous is if you're a man in your older years or if you're outside Disneyland without a poncho. Now let's move on to pendings. These are the homes that actually went under contract in the month of August. Detached pendings came in at 1,358, which is up 2.6% year over year. Nothing earth-shattering there, but it does mean demand is still holding. On the attached side, pendings landed at 706, basically flat, up about 1.1%. The year-to-date story tells us a little bit more though. Detached pendings are down 0.5% compared to last year, and attached are down almost 5%. That means while August was technically positive in the big picture, demand hasn't been running ahead of last year. It's just been treading water. And here's the catch. When you line this up with the new listing data that we just covered, detached inventory shrank 18.5% in August, while pendings grew. That combo tells us that buyers are still scooping up detached homes faster than they're coming to market. That's why detached is the side of the market that could get tightened up real quick if mortgage rates keep dropping. Now here's a local snapshot that proves this point. In La Mesa, zip code 91941, detached new listings were completely flat in August compared to last year. But pendings, they shot up over 41%. That's demand eating into supply, plain and simple. And because inventory also fell double digits, the months of supply in La Mesa dropped by almost 20%. That's exactly what I mean when I say detached homes can tighten up quickly. It doesn't take much for a balance to shift back to sellers when demand is steady and supply isn't growing. Moving to the attached side, it's a little more sluggish. Even though pendings ticked up slightly in August, the year-to-date weakness reflects what I'm seeing with buyers. They're more hesitant to pull the trigger on condos, townhomes when HOA dues and insurance costs eat into their monthly budget. For some, it just feels smarter to wait and stretch into a detached home when rates improve. Bottom line, detached is steady and has potential to tighten, while attached is wobbling and giving buyers more leverage. Next up, closed sales. These are the deals that actually made it across the finish line in the month of August. Detached closings came in at 1,291, which is down 5.2% compared to last year. Attached homes saw an even bigger dip, closing out 655. down over 18% year over year. Now, if this feels like a disconnect from pending data that we just covered, you're not wrong. But remember, closed sales are always a lagging indicator. August closings are really a reflection of what happened with pendings back in July. And while detached pendings were slightly positive that month, attached were negative, which means that combined pendings were still down year over year overall and year to date. That softer demand is now what's showing up in the August closing data. And here's where it gets interesting. In July, detached pendings were 1,395. In August, detached closings came in at 1,291. That's roughly a 93% close rate if you line 1 month's pendings against the next month's closings. Now, not every escrow wraps up in 30 days exactly. Some take longer. But as a general gauge, it tells us that about 93% of properties going under contract are making it to the finish line. That leaves roughly a 7% cancellation rate from month to month. Zooming out year to date, the ratio looks even stronger, closer to 95% closing rate. So despite the dip in August for closed sales, the overwhelming majority of deals in San Diego are still getting done once they go under contract. The takeaway here, closings have dipped, but they're more of an echo of softer pendings earlier this summer. The real signal is that once homes go pending in this market, nearly all of them are still closing. Next up, let's cover median sales price, the metric most people think of when they ask, what's the market doing? For detached homes, the August median landed at $1,075,000. That's up 2.4% year over year and 2.1% year to date. So prices on the detached side are still growing, not skyrocketing, but steadily holding their ground. On the attached side, the story is different. Median price came in at $675,000, basically flat, down 0.1% compared to last year and flat year to date. That's stability, not growth, regardless of credits and price cuts that you see online with Redfin and Zillow. Here's what stands out to me. Since March, both detached and attached markets have bounced back and forth between small positives and small negatives. That's not the behavior of a market racing up or crashing down. It's the behavior of a neutral market. This is something I've been professing for a few months now. Detached is leaning a little stronger, attached is leaning a little softer, but overall, San Diego right now looks more balanced than it does tilted heavily towards either buyers or sellers. Now keep in mind here, buyers aren't seeing big discounts, but sellers don't have runaway pricing power like they did a couple years ago. We're in a spot where both sides can negotiate, and the side with the better strategy usually wins. Now, of course, you're gonna see one-off cases here and there where a home might be negotiated down below market value. Usually in those cases, there are other underlying variables at work. Now let's move on to average sales price, the other big metric we use to track value. For detached homes, the August average came in at $1,458,287. That's up 5.1% year over year, and just slightly positive 0.6% year to date, so almost flat. On the attached side, the average was $823,810, also up 4.1% year over year and 0.6% year to date. Again, practically flat there. So on paper, both detached and attached are in positive territory. And here's the interesting part. If you look back across 2025, we've only had a couple of negative months on average prices. So despite inventory being way up from last year and interest rates being up, demand hasn't fallen off enough to push prices down yet. But, and this is very important here, averages can get skewed real quickly when sales volume is this low. A few luxury closings in La Jolla or Del Mar can pull the countywide average up by a noticeable margin. That's why I always look at average and median price together. And here's a perfect example. In Del Mar, detached homes are actually showing softness. Median prices are down 9% year to date, pendings have been cut in half, and days on market are climbing. But on the attached side, median prices jumped 36% in August. That's not a condo market suddenly booming. That's what happens when a handful of $2 million condos sell in a low volume market. It makes the averages look like they're taking off when in reality, it's just the math being pulled around by a few big ticket deals. The real story in these numbers, median shows stability, average shows moderate growth. And when you put them together, it tells us affordability is the ceiling. Mortgage rates are keeping prices from running away, and at the same time, they're not breaking them either. In any other market with inventory this low, it usually results in values going through the roof. Next, let's talk about market time. This is the time it takes for homes to actually go under contract, also known as days on market. For detached homes, the August average was 39 days. That's up almost 40% from last year and 21% year to date. Detached homes are sitting even longer at 42 days, which is up 27% year over year and 30% year to date. Now, some of this is seasonal. Homes always take longer as we move into the second half of the year, but the size of these jumps tells us more. Buyers aren't rushing to lock into mortgages right now. They're taking their time, shopping around, exploring their options, and waiting for the right property at the right price. On the flip side, this also tells us that sellers are holding firm on unrealistic price points longer than they should. I see this all the time at open houses I host. A listing will sit quiet for weeks. Then it finally gets a big price adjustment and suddenly the open house is packed with buyers. It's not that demand isn't there, it's that buyers are only willing to move when the price makes sense to them. Longer days on market means that buyers have more leverage, especially on the attached side. But for sellers, it's a reminder that pricing right the first time is the difference between a stale listing and a busy open house. Now let's dig into the total active inventory. This is the number of homes actually available on the market right now, and it's probably just as important of a metric as mortgage rates are. In August, detached inventory came in at 3,512 homes, which is up 8.4% year over year. And attached inventory hit 2,573, up a strong 25.7%. So yes, inventory is higher than it was last year, but the pace of growth is slowing down. Since March, these year-over-year growth rates for both detached and attached have been shrinking steadily. And here's why. The market just isn't very sexy for sellers right now. You gotta keep in mind that 80% of sellers are also buyers, which means if they list and sell, they're trading into a higher price point at a higher interest rate. And on top of that, the narrative out there is full of headlines about price cuts and buyer leverage. Put those together, and a lot of potential sellers are just saying, why bother? That's why even with the gains, we're barely sitting more than 6,000 total homes in San Diego County. Pre-pandemic, we had closer to 13,000. So while buyers technically have more choices than they did last year compared to historical standards, supply is still extremely low. This tells us that the longer rates stay elevated, the more this locked-in seller problem drags on. And if rates move lower, say sub 6%, a potential flood of buyers may come back in while sellers are still holding back. And then the market tightens again. This is why personally, I'm hoping that mortgage rates actually stay elevated. I don't want them to go sub 6% yet. I think we need to sit here for at least another year to allow the market to balance a little more, wages to increase, and the job market to strengthen. All right, let's wrap this all together with the total market overview. This is both the detached and the attached combined, the big picture read on the San Diego County. In August, new listings came in at 2,890, down 13% from last year. Pending sales landed at 2,064, which is actually up 2% year over year. And closed sales, 1,946, down 10%. Prices are still holding in positive territory. The median sales price for the combined market was $915,000, up 3.4% from last August. The average sales price, $1,244,943, up 6.7%. So whether you look at median or average, both are still green and kind of ridiculous to fathom. Days on market averaged 40, which is up a hefty 34% compared to last year. That's consistent with what we saw in the individual segments. Homes are sitting longer, giving buyers more time and more leverage. As for inventory of homes for sale, total 6,085, which is up 15% year over year. So yes, buyers have more to choose from than they did last summer. But remember, historically, this is still very, very tight. Pre-pandemic, we were sitting around 13,000 active listings county-wide. The blended data shows us a market that's slightly more favorable to buyers than it was this time last year. Sales are down, days on market are up, and supply has grown very reasonably. Prices are still holding positive though, and the absorption rate remains solid. This is why I keep saying San Diego is closer to a neutral market right now. Not crashing, not surging, just kind of stuck in the middle. And this is not to say that a good deal can't be found, it's just the shape that that deal comes in may not line up with what you originally imagined. And that's a wrap for this week's San Diego Market Matters. I hope this update was valuable and helpful for you to get a better pulse of what the market is doing. Be sure to like and subscribe if you haven't already. If you want to see what the national data is doing, check out the video I posted last week where I covered those details. And I'll post that video in one of these corners here for you to watch next. As always, I'm Karl Kyler, your San Diego Realtor. I'll see you in the next video.